The opportunities to invest in real estate are practically endless, but most of the advice out there is either outdated or just flat out wrong for today's market. So, in this video, I'll be ranking the best real estate investment types in 2025 from F tier, the worst, to S tier, the very best. We'll be covering office, raw land, student housing, senior housing, mobile home parks, multifamily, and many, many more. Plus, I'll give you a bonus category at the end that almost no one is talking about. Now, quick disclaimer, all of these strategies can make money. There are people out there who build fortunes in every single one of them, but some are way riskier than others, and I'll break down the good, the bad, and the ugly for each. So let's get into it. Kicking things off is office, which I put squarely in F tier. Now, office is the problem child in 2025. Vacancy rates have spiked. In places like San Francisco, over 30%. Nationally, office utilization is still only around 50% pre-COVID levels, which is wild. Literally half the desks in America are empty. And it gets worse. Over $500 billion in office loans are maturing between now and 2027. What's even wilder is office used to be considered the darling investment of institutional grade and private equity firms all across the world. And now property values are down right now between 30 and 40%. There's some buildings that are down over 70 or 80%. And with interest rates that are higher, many of these buildings aren't going to be able to refinance. So defaults are coming. Now, people always ask, but Marcin, what about converting offices into condos or apartments? Look, it sounds good in theory, but here's the facts. Less than 3% of office buildings are actually convertible. First of all, floor plates are too deep, layouts are really awkward, plumbing stacks aren't there, and retrofits can literally cost hundreds of dollars per square foot. And most office sits in dead business districts that nobody wants to live in after 6 p.m. So yes, a handful of government subsidized projects have gotten done, but the other 97% of these assets are zombie assets. And that's why LPs and lenders alike have pretty much abandoned the office market, and they've moved capital to multifamily, industrial, and even niche sectors like data centers, which we're going to talk about later here. A good analogy for office right now is a Blockbuster in 2010, where it's nostalgic, but the business model is broken. And worst of all, nobody knows how to fix it. The next one up is raw land, which I put in the D tier. Raw land looks simple, but it's one of the riskiest plays. And yes, it's cheap to get into it because you have no tenants, no leaky roofs, no clogged toilets at 2 a.m. And if you're on the path of progress, the upside can be insane. Literally, farmland outside of Dallas in the 1990s sold for $5,000 an acre. And it actually ended up selling for over $200,000 an acre once the highways went in. But here's the reality. Land doesn't pay you to wait. There's no rent. You're writing checks for taxes, insurance, and maybe debt service if you borrowed money while your dirt just sits there. And here's the thing. Cows don't pay rent. Dirt doesn't ACH you monthly cash flow. The land value depends 100% on outside forces out of your control. Zoning, infrastructure, population growth. If those things don't happen, you're stuck. In Phoenix and Vegas, raw land lost 70 to 90% of its value after 2008. There's a reason why LPs hate this, because it's almost impossible to model cash flow. Pitching land to investors is like pitching a lottery ticket. The only way this makes sense is if you control the entitlements or feed it into your own development pipeline. If you have an active way to create value with that land, you're investing. Otherwise, you're just speculating. Next up is retail. Think about malls and lifestyle centers. I'd rank this as a C tier. See, retail is really a tale of two markets. You have Class A malls with luxury tenants and strong anchors. Those guys are thriving. So for example, Simon Property Group, they've got the best malls and they're packed with Apple, Gucci, Cheesecake Factory. These are experiences you're not going to be able to get on Amazon. So they're thriving. But like Class B or Class C malls, they're dead. Mall traffic in the US has fallen by over 50% since 2010. There's more than 40 major chains that have gone bankrupt since 2017. So when you lose what's called the anchor tenants, you have a massive decline in traffic because those anchor tenants were the reason why people went to all those other little stores. It's a double knock-on effect because you lose the major anchor and then the little stores that fed off the big stores are also struggling, and then releasing or re-tenanting those major centers are difficult, if not impossible, because there aren't as many major anchor tenants pursuing that business model today. Now, the other option is what's called lifestyle centers. So these are the outdoor shopping and dining experiences. And in all honesty, those ones are doing better, especially when they're anchored by big grocery stores or gyms. But if you're betting on mid-tier fashion retail, I mean, you're fighting Amazon with a slingshot. Buying a weak mall today is like buying Kodak stock in the final days. You're just waiting for the lights to go out. The next one is development, and I put that in the C tier. So development is, let's call it a sexy gamble, because when it works, it's amazing. You can generate 20 to 30% IRRs. You can create Class A assets out of thin air and sell them to an institution for a huge profit. I mean, for example, look at the Hudson Yards in New York City. There was a $25 billion of value created in a very small and a very condensed part of the world. But when it goes wrong, it's absolutely brutal. Think about Miami in 2008. It was full of half-built condo towers that never finished. And in 2025, the math is definitely stacked against you because construction costs are up 30 to 40% since 2020 alone. Labor is hard to find. Insurance costs are up. Debt is a lot more expensive. And the lease up to fill these assets is way slower. So unless you're vertically integrated, you can control the construction process, leasing, and management. You're literally juggling chainsaws. Now, my original mentor, when I got into space, Ken McRoy with MC Companies, Ken and Ross, they've been at this forever and a day, and they are developing thousands of units right now because they do control the construction, the costs, the management. They're vertically integrated. So for them, managing this process is much simpler. But still, for most people, development today is high reward, but way too much risk for most LPs. The next asset class is student housing, which I would rank as a C tier. Student housing can definitely be steady if you're in the right market. Don't forget, the US still has over 16 million students enrolled, and big universities aren't going anywhere. At SEC and Big Ten schools, for example, demand way outstrips supply, and rents grow year after year after year. And here's the thing, international enrollment has also rebounded since COVID, fueling major demand at schools in Carolina, Texas, New York, all over the United States. Student housing is growing. But here's the challenge. Tenants, well, they turn over every year. Operations themselves are super management intensive, and the asset itself lives and dies by the university. So if the enrollment dips or a new dorm opens up, demand, it can evaporate. At Penn State, for example, student housing has been a gold mine. But at smaller schools with declining enrollment, investors are getting crushed. This is a profitable but also super noisy space. Imagine for a second 200 college kids sharing walls. I mean, the cash flow is steady, but so is the beer pong at 3 a.m. The next category is RV parks, which I would put in the B tier. Now, RV parks themselves have grown like crazy. For context, today, 11.2 million US households own an RV, which is wild. That is a 62% growth rate since 2010. Now, COVID supercharged this entire lifestyle demand. And in prime areas near lakes, national parks, and beaches, RV parks can pump out double-digit cash-on-cash returns. Brands like Jellystone proved that with pools, Wi-Fi, and events, you can literally turn sleepy campgrounds into branded resorts. But here's the downside. This isn't passive real estate. It is effectively hospitality. And occupancy swings with gas prices, weather, recessions. Take, for example, Florida. One hurricane can wipe out your best months, and you don't know if it's coming. Also, financing is really hard to get. While you could get 70 or 75% leverage with multifamily with Fannie or Freddie, RV parks often max at around 60, maybe 65% with much worse terms. Now, RV parks can be home runs for hands-on operators, but for most LPs, the volatility makes them a tough sell. Next one up is senior housing, which I would rank as a B tier. Now, senior housing is driven by demographics you can't fight. So for context, every day, 10,000 baby boomers turn 65. And by 2035, seniors will outnumber kids in the US. So demand for independent living, assisted living, and memory care is absolutely exploding. That's why REITs like Welltower and Ventas are all in. It is literally a long-term play with tons of baked-in demand. But operations are super heavy. Margins in senior housing are only about 25 to 35% compared to maybe 50 to 60% in storage. Staffing is also super tough. Regulations are strict, and the costs, they're only rising. Some operators, for example, like Brookdale, have struggled really badly. Others, like Welltower, have thrived by partnering with healthcare providers and creating more of a strategic network. So it really is an operator's game. So if you've got the right team, senior housing can be a really strong asset. It's really not for passive investors to try to just do it on their own. The next one is medical plazas, which I would rank as an A tier asset. Now, medical plazas are actually one of the most stable income plays out there because, see, healthcare actually makes up almost 20% of the US GDP. And by 2030, one in five Americans is going to be over 65. And tenants in that business are sticky. I mean, you take, for example, a dialysis clinic that has radiology equipment, they're going to spend millions of dollars to build out their space. So they're not going to take moving casually. So REITs, for example, like Physicians Realty Trust, they report 95+% occupancy. If that isn't proof of stickiness, I don't know what is. Now, what are the risks with this sector? Well, you have really expensive buildouts and really slow releasing if a tenant does leave. But essential healthcare demand is rising and it's defensible and it's an LP friendly Class A tier asset. Another A tier asset is self storage. Now, self storage is lean, simple, and profitable. Now, margins in storage are crazy too, often 60 or 70%, which is fantastic in the real estate space. And look, demand here comes from life events, moving, downsizing, divorce, death. Plus, so many small businesses use them for additional storage for the business or inventory. So, storage makes a lot of sense for a lot of people. Now, national occupancy in storage is also in the 80s or 90%, even throughout COVID. And I can tell you that most leases on storage are month to month, which actually gives operators instant pricing power. So, what does that mean? If they want to raise rates, they can raise rates almost anytime they want. So, groups like Public Storage and Extra Space actually use dynamic pricing software, just like airlines, to figure out what to charge. Now, risks. Well, oversupply is a big risk. So, for example, in Denver and Orlando, there's way too much supply added to the market, which actually made the rents fall between 10 and 20%. So, location is definitely everything. But LPs love the simplicity of self storage. It's literally a box on dirt that prints cash. Another A tier asset is industrial. So, industrial has been the darling of the real estate industry. And fueled by e commerce, Amazon alone added 350 million square feet of industrial space between 2019 and 2023. And vacancy rates in a lot of these assets are super low because moving warehouses disrupts supply chains and everything tied to the logistics of that product. Also, rents in infill locations have actually outpaced every other asset class. What are the risks? Well, specialty builds like cold storage or robotic warehouses are really expensive, and repurposing them is a nightmare. Mega 500,000 plus square foot boxes are also slowing down. There was a period where you would see these big Amazon box warehouses showing up everywhere. That expansion has actually slowed down quite a bit. But on the other side, small bay, flex style space is really a sweet spot right now, and it attracts a diverse range of tenants. You've got the last mile delivery logistics going on there, and you've got a really big potential for strong rent growth. So, from my experience, LPs love industrial because it's stable, scalable, and in really high demand. Another A tier asset is mobile home parks. Mobile home parks are actually one of the most recession resistant assets in real estate, period. So here's some stats for you. The average tenant stays for 14 years compared to 2 in apartments. And tenant owned mobile home parks, where the tenant owns their trailer on your pad, means that you just manage the actual pad and the infrastructure. And I can tell you there's over 40,000 parks in the United States, and most of these, believe it or not, are still mom and pop owned. That's why private equity giants like Blackstone are piling in. And manufactured housing REITs like Sun Commodities have even outperformed many parts of the S&P 500. Now, what are the risks? Well, first of all, there's the stigma of a mobile home park. The old school style of mobile home park isn't today's mobile home park, but still that stigma still exists. Zoning battles, very few municipalities want to approve mobile home parks in existing neighborhoods. And also you have aging infrastructure on the existing parks. And if you're stuck managing park-owned homes, you're suddenly managing depreciating assets because unlike real estate that is tied to a fixed asset, the trailer that sits on top of the pad is just depreciating through and through. But the fundamentals are bulletproof. You have sticky tenants, capped supply, and strong consolidation upside, which means that there's somebody out there that would happily buy you if you had 5, 10, or 50 of these mobile home parks in one partnership. Now, the S tier has to go to multifamily apartments because multifamily is the gold standard. If you want proof, look at where you have the cheapest lending and the most abundantly available financing in the country. Fannie and Freddie provide unmatched financing in multifamily, over $70 billion a year plus, and they have the best terms and the best rates in the industry, bar none. Why is that? Well, demand is constant. People always need housing. LPs, as investors, love multifamily because it's easy to understand, easy to underwrite, and pretty simple to actually scale. And when you add the value add strategies, when you renovate, improve operations, and raise rents, you can force your own appreciation. Disclaimer here, not every multifamily deal is S tier. Location, age, and obviously the operator quality matter quite a bit. And yes, you can absolutely lose money in a bad multifamily deal. But as an asset class, multifamily sits at the very, very, very top. And historically, it's also had the lowest default rate of any commercial property, bar none. That's why it's the king. Here's a bonus category for you: data centers, the traditional and AI based. Think of them as the apartments of the internet. Every Netflix stream, TikTok scroll, an AI prompt that you run through goes through one of these data centers. And the global market is projected to top over $500 billion by 2030. The tenants are sticky. Microsoft, Google, Amazon, they sign 10, 20-year leases and invest millions of dollars in infrastructure. Plus, once they're in, they're definitely not going to be moved. Plus, AI is supercharging demand through the roof. NVIDIA projects AI data centers will consume over 30% of global electricity growth in this decade. Think about that. 30% of the growth in electricity demand is coming from these things. It's the way of life today. These facilities need 5 to 10 times more power and cooling than the legacy centers. And a single site that's AI based can cost over $500 million to build. It's super capital intensive. But the demand is exploding. And that's actually why Blackstone, the largest private equity fund manager in the world, has already committed over $25 billion to this sector. Just like people need apartments, robots are going to need the data centers. And right now, robots are paying way more premium rents than humans, which is why data centers is a trend that we definitely need to follow. Here's the takeaway: the asset class doesn't make you the money. The execution does. Look, I've seen people lose a ton of money in safe multifamily deals and make fortunes in risky land plays. So the real question to ask is, which category matches your experience, your capital, and your risk tolerance? So you need to pick your lane and get really good at it. Build your track record and then expand. So if you found this content helpful, hit the subscribe button. It really helps me out. It tells the algorithm that this is the kind of stuff you want to see, which really helps us get it in front of more people just like you. I put content out there for capital raisers, deal makers, and people who are really tired of playing small and are looking to be able to tap into their unfair advantage. I'll see you on the next video.